Okay, welcome back to the show. I'm Arif Halaby, Total Financial Solutions, Safer Money Hour. Jeff Gerard and Gary Leach, we've been talking about some of the different things that are going on with the mortgage world and ways to kind of balance your financial life. How do you get that extra loan? Look, sometimes when money is cheap, the job is to refinance, right? So, you know, Gary, I was listening to the show as I was on my way to the station, and I was looking at a couple of things that you had said in our own life and working with some of our clients. Student loans really kind of emphasize how does that impact somebody's financial life. And here it is, guys, because what you're doing is you're borrowing money in a family parent loan, and you're doing so, you know, you're 48, 55 years old, and you're borrowing money for your daughter or son's college, and then you say, now I'm going to buy that vacation home. Except what's the problem with that?
We treat student loans, Arif, just like a car payment, credit card. It is a monthly debt obligation that we have to count in your debt-to-income ratios. I've done several refinances in my career where parents are paying off their student loans because being rates are so low. We're doing a lot of that.
And so we're able to refinance those out of that. But what about having that student loan impact their ability to buy their vacation home or to even retire? I mean, are you seeing some of that pressure with, your debt to income, meaning the amount of debt that you have on a minimum monthly payment versus the income that you're making, that ratio or that difference is just not the right place?
Yes, like I said, we would have to take care of that obligation, whether you pay it off or you qualify with that debt.
So have you seen it impact them? Like, hey, you can't get that vacation home, or you can't retire to that home in the desert or in the mountains or the beach or whatever it is until we get something else paid off.
Absolutely.
Yeah, so it can be a struggle, guys. So when we talk about student loans and being careful about taking them out, especially as a parent, you can have your child take them out and help pay them, but it sits on your credit report and can impact your either refinancing or either getting yourself in a boatload of debt and not be able to buy the boat. For example, the sailboat.
And you know, it's funny that, not in a funny way, but it's peculiar that we don't think about the long-term effect of helping our children in that fashion, where it's almost more painful to, I would say it is more painful to stroke a big check, or to make a monthly payment every single month, but signing your name on the dotted line for your child, that's so easy, right? It's like swiping a card at the, you give cash away or swipe a card at the grocery store. You can definitely feel the difference there. So signing your name, I mean, that's a long time. And we're seeing, 10, 15, 30 years of student loans?
Now, Gary, this is Gary Leach, by the way, folks, from Wells Fargo. His job, if you will, is to help refinance. We've seen him help a lot of our clients out over the years. And as a former neighbor, I've known him for, 10 years or more maybe by now.
Yeah.
Gary, one of the things that we have seen is people are refinancing debt, if you will, and paying down payments because interest rates are at all-time lows. But sometimes we fall for these, I want to say, radio commercials, TV commercials, billboards that'll tell us, get the lowest rate, call today. But sometimes those are a little bit misleading, aren't they?
Yeah, I feel they are. I mean, I think there's hidden fees, etc. I mean, if you are getting into a transaction, I would recommend getting we call it a loan estimate these days, and then,
it used to be called a HUD-1, is that right?
It would have been...
Same, I think?
Well, that's your closing disclosure. It'd be like a fee estimate, loan fee estimate.
And that's before you close then?
Yeah, so you'd want to see that before you begin a transaction with any lender.
Okay. And so watch out for some of those hidden fees, guys, if you're doing some of those, quick, either online, billboard type ads.
Because those are really attractive. I mean, someone says no fees, no closing costs, no appraisal fees. I mean, nobody works for free.
Yeah, so how would these people do it if they're saying that? They've got to be hiding fees somewhere, I'm guessing.
Yeah, that's a tough question to answer, Arif. I can't speak for others. But like I said, I would just get a loan estimate, do your due diligence, do your homework, shop around, and make sure you have everything in writing up front.
When it comes to some people will go out and have two lenders almost simultaneously doing the work. Have you seen that?
Yes.
Yeah.
Yeah.
What's your thoughts on that?
I mean, that's the consumer's choice. They call it double application. I believe that's what they would call it. You see it sometimes on purchases. You don't see it a whole lot on refinances.
And so meanwhile, they're going down the road and they're having two lenders, I guess, do all the work up until there's got to be a point in time. Maybe is it before signature? Or is that it? At that point in time, they say, I'm not going to go with you, I'm going with you. Or they pit you against each other to try to reduce fees, I'm guessing.
There's really, that's out of my control. I mean, that's the consumer's decision on what lender they would go with at that point.
But are you seeing that some of the consumers out there, the customers, they're not even telling you about this? Or how often will they tell you?
Not very often.
They'll usually say, hey, buddy, we're bidding you against so-and-so mortgage down the street.
A lot of my business is referred, similar to you.
Yeah.
So there's some trust there. It's all about trust and knowledge. You need to be knowledgeable about what you're doing for a living.
Yes. Are you finding a lot of consumers today, because you've been doing this for a while, how many years?
13 years now.
Okay. So 13 years ago, certainly the interest or the internet was around, but it just wasn't, it didn't seem anyway, as interactive as it is today. Are you finding that consumers are maybe pushing their knowledge to a higher level lately?
Yeah, I feel people are very savvy in their day-to-day business and choices. I'm sure you see that.
Sure.
In your line of business as well. So absolutely.
Yeah. And Jeff, one of the things that you were talking about was debt to income ratio. We kind of get into some of those conversations. How do we eliminate debt? How are we getting it's healthier for you anyway, but at the end of your financial life, the goal is to have more assets, which means things that can go up in value versus liabilities, which are things that go down in value. So many times, and we may disagree on this, Gary, but we say be very careful if you call the house that you live in an asset. It may go up in value, that's great, but we all have most of us anyway, have lived through the 2008 time frame when our homes did not go up in value. In fact, it was a liability, and for some it's still that anchor around your leg as far as what you owe versus what it's worth. But if it's something that you're buying as a second home or a vacation home, or if it's that rental property, I think people should have rental property at least as a conversation or a consideration in their financial life. But what's the best rates that you're seeing and down payments when it comes to rental property?
Like I told Jeff earlier, minimum would be 20% down on investment property.
That's the best.
Yes.
Now, where does the line become investment property versus my second home? Because for some people, it may start out as their second home, and then maybe they're sick or they can't go there or they choose not to, and it becomes a rental property later.
That's a great question. From our underwriter's perspective, a second home is described as a vacation home, like Palm Springs, Mammoth, Big Bear,
Woodland
out
Hills.
of state. No, not Woodland Hills.
Okay.
No, they would.
Says you.
They would catch that.
Van Nuys. I'm not going to vacation to Van Nuys is what you're saying.
Absolutely. But, out of state, I do several, vacation homes in Las Vegas, for example, at 10% down.
Okay. So vacation homes can have a bit of a difference. Is there a limit? Like if I want 10 homes, I mean, maybe vacation homes, I guess if you're wealthy enough, you could have 2 or 3 or 4 vacation homes, but is there a limit, or is it purely an income to debt ratio?
Both. You can have a maximum of 8 financed properties, but we can gain an exception for that 9th property, etc. And it is all about debt to income ratio.
Wow. Okay. So what if you want to become the next, multi-millionaire real estate mogul? You have to do it differently, I guess, huh?
Like I said, we can gain an exception on over 8 financed properties.
And that's at 20% down still?
Yes.
You're still doing 20% down?
Yes, absolutely.
So maybe 8, 9, 10, or whatever it might be, I may have to put 30 or 40 or 50% down.
Maybe to help you qualify for your debt ratios?
Well, not necessarily qualify, but just to even get the loan. Let's say my debt to income ratio is great, my rental property income is awesome, I have money in the bank, and I still want to take advantage of the lowest rates. There's still a line there where I may have to put a bit more down because they're saying, wait a second, buddy, we're taking a big enough risk with you. We already have 3 of the 8 loans. Would some lenders not want to take more than, or is 8 total financed with your company?
Well, I mean, we can, like I said, we can get an exception past that 8 finance properties. But bottom.
But real quick, when you say 8 finance, I just want to be clear on that. Is that with Wells Fargo, or is that
No.
just I can have it?
Whatever shows up on your credit report.
So 8 different places. Okay. Wow. Interesting.
That is very interesting. What about, going back to my question earlier, when I don't know, I called it in my head asset-based lending, but if someone has money in the bank, or let's say someone has a property that's paid off and they want to take a mortgage against the house to either buy who knows whatever they want to do. Does that help them qualify as well with getting a sizable amount against the property if they have very little income?
Absolutely. Like I told you earlier, we do have a program, asset dissipation. Well, we'll look at your assets and qualify you on the amount of assets you have.
And then that home would also count, or the home equity would also count as part of the overall asset portfolio?
The equity position, no. If you were to take cash out of that property, that would help.
So it's purely a
Yeah.
liquidity play.
I
it
see.
Sounds like.
Yeah.
So if you have a stock portfolio or annuity portfolio of a certain dollar figure, you can. So that went away there for a while. Did it?
Well, I
After-
really don't. I mean, other lenders, I'm not sure. We've had it for a while now.
But didn't it
I've
go
been
away after
using
the crash?
Yes.
And then.
Yes, but we are using it daily as far as qualifying people.
Okay, that's nice.
And what are you seeing in the home equity line? Do you guys do much mini HELOCs anymore?
I do, yes. Home equities we run with will go to 85% combined loan to value. So say if you have your LTV on your first is at 70% and you want to pull cash out to do a swimming pool, we can go take 15% more of equity at your home and do a home equity.
Nice. And then some of those same guidelines apply, or are you seeing?
yes.
Is it a little
Yeah,
bit more
everything.
stringent than a first mortgage, maybe?
They're pretty close. It's all
I see.
underwritten by an underwriter, and they look at everything with a fine-tooth comb.
Gotcha.
Do a lot of these guys today, are we still taking out home equity loans to put in backyards and pools and front yards and all of that? You
It
still
is
see that?
happening. Yeah, now the values and equity positions are up for most of your homeowners. You are seeing that, yes.
I'm hearing lately a couple of folks I've talked to have said that they've searched for home equity lines, and a lot of lenders are saying they won't do standalone. These are their words, standalone HELOCs.
What's that mean?
Meaning that they'll give you a HELOC, but they'll only do it if they refinance your first mortgage.
I see. And that HELOC, folks, is the home equity line of credit. Acts like a credit card kind of on the house, where you don't pay interest unless you actually borrow money, and then you can pay it back and borrow again and pay it back.
Right.
And borrow again. So are you seeing that Jeff is saying the stand-alone home equity line of credit?
Yeah, we're not really pushing that product. I would look at the borrower's interest rate on their first, and then I would make a conversation with the client to see.
Heck, if we can beat it.
If their interest rate is high on the first, I would just do a cash out on the first and just do one loan.
And
So we do that.
Are you still finding those 8-9% loans out there?
No.
Yeah, I don't find them much as our clients come in. Often people today have refinanced. I mean, maybe they're down to 6 or 7s. I don't know, but I don't see too many 8s or 9s anymore.
No, I haven't seen that in quite a while.
Yeah. We're going to take a break, folks, so we're going to return in just a minute. But grab your pen and paper. I'm going to give it to you again. And also, when we come back from the break, Gary Leach, his phone number is 661-433-7798. That's 433-7798. Wells Fargo Mortgage, somebody that I've known and worked with for quite some time, probably over 10 years, folks. We'll be back in just a minute. I'm Arif Halaby, along with Jeff Gerard. Special guest from Wells Fargo, Gary Leach, AM 1220 KHTS. Hey, welcome back to the show, Total Financial Solutions, Safer Money Hour. I'm Arif Halaby, along with Jeff Gerard and special guest Gary Leach from Wells Fargo Mortgage. Look, obviously, guys, I want you to pay attention here, because part of the strategy of getting a loan, that's usually the last thing that you do. You have to prep for it, right? You have to make sure your finances are in order. You've heard us talk about things called debt stacking. Now, what does that mean, and what is it? Debt stacking is often for people that have numerous debts, especially those that are things like credit cards and car payments, where there's revolving credit and there's fixed, right? A car payment, you have 60 months or 4 years or whatever it is, and when it's done, it's done. In a credit card, there's often a minimum payment, and so as you are paying down the balance, you are also having a lower payment each month or every other month. Now, why is that a big deal? Because I don't want you to pay that minimum payment. I want you to pay more. Now you go, oh, Arif, I do. I send $100 to this one and I send $50 extra to that one. No. Here's how I want you to do it. And it's very simple. You're going to write down all of your debts. I don't care about interest rates. One of the tricks that you're going to hear a lot in the financial world is people will try to deal with the interest rates, and that is wonderful if you're trying to save money. We go, well, who doesn't want to save money? No. If your goal is to get out of debt fast, it's a different strategy altogether. Paying less in interest, great, but it might take you 6 months or 6 years longer to get out of debt. But let's work on getting out of debt faster so that you can qualify for the better loans, so you can get a lower interest rate, so you can refinance or buy that vacation home or whatever it is. But let's get rid of that bad debt right away. How do you do it? Once you write down all of your debts, your car payments, not a lease, but a car payment, and not your electric bill, because that's a recurring bill, that comes out of your expenses, right? That's different. Your debts are made up of things that you have bought and you are still, and it might be gone or it might be worth less than it is than when you bought it, but you still have the payment. It could be your Best Buy, it could be your gasoline card, it could be an Amazon credit card, I don't care what it is. You take all of those things and you write them down. And you write the minimum payments down. Now, what's the extra amount that you add? Well, I throw an extra $10 to this one and $50 to that one. I want you to add up all of that extra payments. And next month, you're going to pay the minimum on everything. Up. Keep your hands on the wheel. You're going to pay the minimum on everything. And you're going to take that extra money and you're going to target one debt at a time. Now, which debt? The highest interest rate? No.
Nope.
It is what, Jeff?
The lowest balance.
The lowest balance. Once that lowest balance is paid off, you're going to take the minimum payment for that lowest balance plus all of that extra money, and you're going to target the second debt. But meanwhile, however long as it takes, those minimum payments that you were making on the other debts are going to become fixed payments. And here's what I mean. If you have a car payment of $500 a month, it's always $500 a month. The day you buy your car and the last payment. That's a fixed payment. With a revolving debt, like a Discover or Visa or MasterCard, those change every month as you pay down the balance or increase the balance. But in a debt stacking mode, you're going to pay the minimum payment that it is today. And yes, I get it. Very little goes to principal. But next month, when they lower that payment, minimum payment, you're not going to do it. Today's payment will be the payment until you either add it to the debt stacking program or it's paid off. When you do that, you are increasing the amount that's going towards principal rapidly. You're getting out of debt. You add your student loans to this, absolutely. You add your kids' student loans to this, yes, absolutely. You can keep a separate ledger. I'm all good with that. And that separate ledger says, Susie, Jimmy, you guys owe me. I'm paying this. Now, if you drop out of school or you got stuck in one of those ITT Tech Institute, I don't want to say scams because I don't think it's a scam, but it's certainly a bit of a trick, right? You end up paying 4 years tuition whether you go 1 day, 1 week, 1 month. Tough luck. You had to pay the whole thing.
Right.
You got stuck in that program. If it's 2 years, whatever it is. Even if you're stuck in those worlds, you can keep a ledger for Jimmy and Susie to pay you back. But I don't want this to hinder your retirement opportunity. I don't want this to hinder your plans to buy that vacation home or that RV and travel around the world. Whatever it is that you wanted to do. And you might have a plan. Look, when you graduate, I'll take half of it off, but you got to pay the rest of it. Or you got to pay me $100 a month until you're 30 years old. I don't care. Whatever plan you have with Jimmy and Susie or whoever, how many of her children you have. And then you'll remember, no more parent plus student loans. Oh, but if they want to go to Arizona State University and it's all out-of-state tuition. I can't tell you how many times I've heard that. Yes, there's 75,000 students or some crazy number that go to Arizona State University. Everybody gets out-of-state tuition. There's tons of scholarships. How about go to community college? Oh, I know, College of the Canyons. Oh, but Arif, that's nice for some kids, but not mine. It's mature. They want the 4-year experience. Great. Do they have any money? No. Forget the 4-year experience. I used to make a joke. I said, I wanted to be 6'2" and marry a supermodel. I'm much happier at 5'8", and I know I'm stretching that, but I'm wearing heels. And with my supermodel. But please, I don't care what you promised Susie at 2 years old. I don't care what you promised Jimmy at 15 when he said he's going to go to Harvard. Great. Do you have the money? No. Well, then you don't go to Harvard. I'm sorry, there's just no money. But be very careful as you end up crossing that line, because those student loans land on your credit report, which can affect you for the rest of your life. All right, we're going to finish up with Gary Leach here, guys, because the loans that you get to refinance your house, I want you to encourage you. Look, we have, this year is our 20th year in business. June of 1996, we started as in the financial world, if you will, after going through a process of being ripped off and scammed, and we lost a lot of our money at the age of 26 years old and had to start over. It was a very difficult pathway. Part of that was being late on some of my homes and payments, if you will, and trying to get back on track, right? Because there's ups and downs, all of us have. And you got to figure life out a little bit. Today, some of you are still recovering. Gary, what do we need for those that are just trying to get back on track? Maybe you have a late payment or a foreclosure, or maybe you had 2 or 3 foreclosures if you had rental properties, right? How do we get back on track?
Well, guidelines are loosening up now. So we, like I said, we make exceptions. We look at the, overall portfolio of the client, and it's all about risk, right? So we have, several people that have been in the workforce for several years, had some issues, like you said, with foreclosure, bankruptcy, short sales. It's case by case. I recommend, speak with myself or another loan officer, and bottom line, we have to run your credit, look at your credit, and see what's going on.
So, Gary, one of the things that I see when we talk to loan officers, sometimes some of the guys out there will promise you anything. You've not been like that. I mean, I've literally called you, I think even on weekends, when I've been sitting with the clients. Sometimes I even know late at night, and I'll grab you on your cell phone. And folks, grab your pen here. I'm going to give it to you again, 661-433-7798. And I'll say, hey, Gary, here's the situation. Client is this, this, and this. Is there something you can do? Sometimes you'll say, oh, yeah, we could handle that. Sometimes you say, I don't know, have them call me tomorrow. It sounds like there might be something. And sometimes you'll just say no.
Yeah, I mean, I don't want to ever misspeak or guide someone in the wrong direction, being a professional. I would, if I don't know the answer, I would get back to you the following day after speaking with a lending manager or underwriting manager, if it's a unique situation. But I'm always available.
I like the fact that there's no sugarcoating it, or kind of, I guess you call it what, bait and switch, where you...
Yeah, I can't tell you how many guys, back when I was trying to buy a home several years ago, and people would get us excited about something thinking that we could be helped. And then you go down a process of 2 or 3 weeks, and then they give you the bad news that, hey, we couldn't help you, when maybe that wasn't their niche, or you had to have a certain program that they didn't offer through their lending institution. So I think a big part of that is, that being upfront and transparent is important.
And it's helpful, guys, to have somebody on your team. It might take 5 or 6 months to get through some of the debt stacking plans. And one of the things I want to encourage you, sit down with your lending officer, and when you do, you have a conversation of which of these debts should I focus on. Maybe one of them, because if I have a car payment that has 4 or 5 months left, does that impact my...
No, we wouldn't count that against you.
Because
anything under 8 months, we would not hit you with that payment.
So if something is already on its track to be paid off in 8 months, I might say don't include that in the debt stacking. Let's focus on some of the others so that we can eliminate the bad stuff that's hurting your score, that's keeping you from getting a good interest rate, and focus on the other side, which gives you the positive savings and put you on a healthy track. But Gary, sometimes people are sitting down with you and they're not doing a loan today. They'll stay in touch with you every month or so until they get right where they're supposed to be.
Yeah, the key is follow-up, Arif. Email, text, phone calls, and have a plan. I mean, I love meeting people face-to-face in the bank branch and, get them pre-approved or have a game plan put together for them.
It's helpful, folks, to have somebody like Gary on your side where you're walking through the process and you realize, what are you trying to achieve? Because maybe you think that the house of your dreams, whatever that price is going to be a certain dollar figure. But by the time you add taxes and insurance, folks, you may not be saving as much as you thought going from a renter to a buyer. You may have to put down more money or reduce those expectations or save more right? I've seen both of those things happen.
Well, and I'm guilty of that myself. In my 20s, I thought, well, I'm going to buy a house, and I certainly wasn't ready for that because I was looking at maybe a mortgage calculator, and like I said earlier in the show, people get excited about something and they're not thinking about the ancillaries, taxes, insurance. What if property taxes go up? I've seen my mortgage change probably 3 times, increase in the last 5 years, and that's just because my escrow account and my insurance has gone up and my taxes have gone up. So those are all considerations that I think, like you said, having a plan is the most important part.
Folks, I want you to go to our website. You can go to tfswealth.com. TFS stands for Total Financial Solutions. Wealth, as in a lot of money.com. Send us a message if you have a question. If you certainly want to follow up with Gary, we'll kind of help you guide and we'll get you his information. So if you are driving, you don't have a chance to write it down, you can certainly go through hometownstation.com, click on Total Financial Solutions, and that'll send you any information that we have as well. Gary's phone number, one more time, is 433-7798. That's 661-433-7798. Hey, thanks for joining us, Gary, and being a part of the show.
No, thank you, Arif. I appreciate it.
We kind of roped him in, folks, at the last minute, just so you know. He didn't have a whole lot of preparation. We're just like, hey, Gary, we'd like to, because I'm getting so many questions. In fact, even this morning, a client was talking specifically about this and about borrowing money for a vacation home, in fact, in Palm Springs, a condo. And so we had that exact same conversation that you might be thinking, and I think it's key that we have somebody like Gary on the phone available to you at any time, and certainly by listening to this show. HometownStation.com will guide you over to us. Jeff, one of the things we want to focus on is in the next couple weeks, we have more guests coming on board, if you will. Tell us a little bit about some of those.
Well, we're really focusing on having folks that can come out and bring a lot of value to our listeners. So if you have any requests or some subjects you'd like us to cover, we can bring an expert out in that field as well and interview them on the radio. So just send us a message on tfswealth.com.
Yeah, there may be somebody or an industry that is interesting to you, like, hey, can you bring on an expert in this field or that field? And that can be helpful, of course, to kind of guide and direct our shows down the right way. Thanks for listening. I'm Arif Halaby. Look, we've got some client dinner seminars coming up. TFSwealth.com will get you right in touch with that as well. I'm Arif Halaby. That's Jeff Gerard. And thanks again, special guest Gary Leach on your place for news, talk, and information every week at this time, Tuesdays at noon on Total Financial Solutions Safer Money Hour on AM 1220 KHTS.